Good morning, Gabe. I recently inherited a bit of money from my grandma. I think I want to buy some stocks and bonds, but I really do not know much about them.
Esther, please accept my condolences at the loss of your grandmother. It is a blessing she wanted to look out for you in her way. I think you are right on track to consider investing. Do you have an idea what you prefer?
There are some things I use that interest me. I shop on Amazon. I have an iPhone. My cell service is with Verizon. I still love going to McDonald's. Both Netflix and Disney Plus are my favorites for watching movies online.
You have excellent taste. You have picked some of the strongest companies in which you can invest. Without even looking up these companies, the fact that they are universally known and provide such popular products and services make them good prospects. But first, we need to talk about the differences between stocks and bonds when considering investing. Welcome back, YouTube community. Gabe here. Last time, we talked about your YouTube business and discussed the difference between a Roth IRA and a traditional IRA. Today, let's talk about capital stock and bond investing. There are some basics that can help a novice better understand what they are and how they work. Shall we begin? Esther, you're a campground host. Tell me about your YouTube business. How do you access the internet when on site?
I love photography. I started a blog talking about campgrounds around the country and created a YouTube channel to share my nature images and videos. Many sites have Wi-Fi near the ranger stations that I can use. As a backup, my portable Wi-Fi and cell service get decent signals in most places. It shouldn't be a problem to set up and manage an investment account online. I just don't know much about investing.
Let's start from the beginning. Any business that sells goods or services has the basic goal of growing that business. Often when the potential for growth exceeds the amount of cash generated from their income-producing activities, additional cash is needed. There are two primary ways in which a corporation can raise additional cash. They can borrow money, or they can issue stock. There are several ways to borrow money, from getting a bank loan to selling a corporate bond. We will discuss that shortly, but first, let's talk about stock. Capital stock is a representation of the ownership of a corporation. When a corporation is being formed, or when they need additional money to help grow the company, the corporation can issue stock. Issuing stock for purchase can give a company cash on hand in order to buy things to sell, or purchase machinery and other assets in order to manufacture things to sell. Stock can be sold privately, however, it is more common for larger corporations to use a stock exchange in order to better reach the numbers of potential purchasers of their stock. These transactions are heavily regulated in order to prevent fraud and protect investors. Typical exchanges are the New York Stock Exchange, the Shanghai Stock Exchange, the Nasdaq, or the London Stock Exchange. The buyer of a share of stock is often given a certificate that is evidence of the partial ownership of the corporation. Issuing stock certificates to the buyer are a mere formality, and are done if specifically requested. Buyers can set up an account at a brokerage firm in order to buy and sell stock. Your brokerage account keeps track of your ownership shares. They will not issue a stock certificate to you directly, unless you request it.
If I do not get a stock certificate, what do I get?
When you purchase a share of stock, you are purchasing a fractional ownership interest in the corporation. You are now an owner entitled to a share of the company's earnings, called dividends. You are entitled to vote on the affairs of the corporation at annual meetings. You are entitled to proceeds from the liquidation of assets, after payment of debt. That little issue of dividends is important. When you buy stock, you are giving a company your trust that they will use your money wisely, grow the company, and show their gratitude for the use of your money by returning some of the net profits back to you, the investor. Their gratitude is shown in the dividends they pay. Many larger, well-established corporations pay dividends on the net earnings quarterly or monthly. Your fractional ownership interest entitles you to a fractional interest in the earnings. The board of directors vote on an amount to return to investors each year. A voting interest can be a valuable part of owning stock. But there is one thing to be aware of. Not all stock is necessarily equal. Some stock can come without voting rights, some with enhanced voting rights. Stock can be issued with a certain priority to receive profits or liquidation proceeds before or after other classes of shareholders. Some stock can convert from one type to another, like from common stock to preferred stock. Preferred stock often has a preference when it comes to the payment of dividends, but typically has no voting rights. There is also preferred stock that can be a hybrid of having the qualities of fixed returns, like a bond, as well as voting rights similar to common stock.
That just got confusing real fast.
Oops. Let me gear down. As I mentioned before, the two ways that a company can raise extra money is to sell stock and to borrow. Let's talk about that second way to raise money, borrowing money. The two main ways to borrow money are getting a bank loan or selling bonds. Banks are primarily used for the short-term use of money in the form of loans or lines of credit. For longer-term use of money, bonds are a preferable way to raise cash. Nearly all of the average daily trading in the U.S. bond market takes place between broker-dealers and large institutions in a decentralized over-the-counter market. However, a small number of bonds, primarily corporate ones, are listed on exchanges. Lots of organizations sell bonds, from corporations to municipalities to the United States government. When an organization borrows money, they are required to pay something for the use of that money over time. That payment is interest. When you buy bonds, you are paid back interest for the use of your money over time. The interest payment is in the form of a coupon. Many municipal bonds will pay for 10, 15, 30 years or more for the use of money.
Is there an advantage in buying bonds over stocks?
Good question, Esther. Actually, there is an advantage. When a company borrows money, they must pay back that money before they can pay any dividends on the net earnings, plus interest. Unless a preferred stockholder has some form of hybrid stock, the bondholders will always be paid before the shareholders. And that can play a huge role when a business is going bankrupt. Let me give you an example. When a business is started, the owners contribute cash. That cash represents the equity they have in the business. They use the cash to purchase capital assets. Capital assets are things you use to generate business income, like machinery and automobiles. When they make sales, and pay their expenses, the profit adds to their equity. But as the company grows, they may need more cash than is generated by sales. They can borrow money to purchase capital assets, and help fund operations. Or they can issue stock in order to generate cash for business activities. As the business grows, the money borrowed gets paid back first. Extra cash is used to keep growing the business. If there is enough extra cash, the owners can vote to pay a dividend to the shareholders of the stock. Companies in the early stages of growth may not pay a dividend for years in order to keep the company growing. Other well-established or mature companies want to reward investors for their trust. They will vote in a regular dividend that gets paid monthly or quarterly.
You mentioned the priority for who gets paid when a business starts to go down.
Yes, I did. When a business is failing, and there is not enough cash to sustain operations, the business must pay back all loans first. Then afterward, if there is any cash available, they can return the money invested by the stock shareholders.
Does that mean it is much better to be a bondholder than a stock shareholder?
A bondholder will get a steady payment for the use of the money loaned to a company. True. However, the nature of investing is to enjoy the opportunity for growth. As a shareholder owner, you are investing in the growth of a company. In the long run, your stock will increase in value as the company keeps growing. And you have an opportunity for your dividends to grow as well. Being an investor can be riskier than being a lender. However, the rewards are in the growth and income potential from the company.
I see. If I buy stocks, I have the opportunity to receive dividends, and there is a good chance my stock can increase in value. If I buy bonds, I can get a fixed return on my bond in the form of interest. Do I need a lot of money in order to buy either?
Not really. You can open a brokerage account with companies like Robinhood, Charles Schwab, and Fidelity. They each have different investment thresholds. Once your account is open, You can look up individual stocks or bonds, or funds that have a pool of stocks and bonds. There are stocks, exchange-traded funds and mutual funds. And in the bond market there can be corporate bonds, government bonds, municipal bonds and bond funds that pool a group of bonds into a security for purchase.
I understand. I see why you asked if I had internet access. It sounds like a lot of research needs to be done if I want to invest in any stock or bond fund.
Start with what you know. You mentioned a few companies you are familiar with. Some will pay a dividend, some will not. Open a brokerage account. Take a look at a stock chart. You will notice that many of the stocks that do not pay a dividend have a stock price that has grown a lot over time. And other stocks that pay a dividend might have not shown much price growth. Study the stock charts of Amazon, Apple, Disney, Netflix, Verizon and McDonald's. Pick one that pays a dividend, and one that does not. Then buy a small amount of each. That is the best way to put a toe in the water. As you familiarize yourself with stocks and charts, you will better be able to decide which is best for you. I will soon be creating a video on growth versus income investing that can help you plan out a strategy for long-term investing.
Thank you for going over this with me. I have heard of Robinhood. I will start there and do like you said, dip my toe in the water.
Esther, I'm glad I can help. Remember, I am not a financial advisor, and do not own any shares of stocks that may have been used as examples in this video. All examples are hypothetical and are for illustrative purposes. Please use this information for educational purposes. Consult your tax professional, investment advisor or attorney for further guidance in your specific situation. Acorns is an easy way to start investing. Please use the link in the description section to get off to an easy-to-manage start on your path to capital asset wealth investing. Although they are not a sponsor, this channel does receive support when you use the link to open an account. Please leave any questions in the comments section below. Let me know if there is a subject you would like to see a video on in the coming weeks. Please like and subscribe with a click to the thumbs up below. Have a great week. See you next week with more tips for your YouTube business. Cheers.